Welcome to Strategy Saturday. I'm Charles Carillo, and today we're going to be discussing understanding the London Interbank Offered Rate, or LIBOR. LIBOR rates are calculated for 5 currencies: US dollar, the euro, the British pound, the Japanese yen, and the Swiss franc. And the borrowing periods or maturities range from overnight to 1 year, and they're published each business day by Thomson Reuters. Now, many financial institutions set their own rates relative to LIBOR. And currently, at least $350 trillion in derivatives and other financial products are tied to LIBOR. And this includes credit cards, syndicated loans, student loans, individual variable mortgages, and the list goes on. Now, if you have a credit card, you probably already have a financial product that is tied to LIBOR. Check your statement and you will see how they calculate your interest rate. And usually it'll be LIBOR 1 month or 3 month maturity plus their margin, or they'll utilize prime rate plus their margin. Now, the most popular LIBOR is the 3-month US dollar rate. So what does this have to do with real estate? Well, typically all variable real estate debt is based off of LIBOR, while fixed debt is based off of the 10-year treasury. In 2008, 60% of prime adjustable rate mortgages and all subprime mortgages were indexed to LIBOR. The LIBOR was created by a Greek banker in 1969 when he was arranging an $80 million syndicated loan for the Shah of Iran. And when I say syndicated, that means there's a number of different lenders that were put together to make this loan possible. Now, LIBOR came into widespread use in the 1970s and the 1980s, and is the average interest at which major banks around the world borrow from each other. Now, LIBOR is calculated daily when the British Bankers Association, or the BBA, asks major banks around the world how much they would charge other depository institutions for a short-term loan. The BBA takes out the lowest rate and the highest rate and then averages the remaining figures and publishes this rate. Now, in 2012, the LIBOR scandal was discovered, which included several bankers at major institutions who were rigging the rate, and it had been discovered that this started as far back as 2003. So, in 2023, we're told that LIBOR is being phased out according to the Federal Reserve and regulators in the UK, and will be replaced by the Secured Overnight Financing Rate, or the SOFR. But at this time, if you are borrowing variable adjustable debt, you will most likely have a rate that's tied to LIBOR. I know bridge debt and other loans we're getting that are variable right now in real estate are tied to LIBOR. Usually you'll see something like LIBOR plus 2.5 or plus 3 as being the margin. And the SOFR is based on prior activity of overnight U.S. transactions, while the LIBOR is prospective. And what that means is that the LIBOR is easily manipulated, and that's what happened to the scandal that was discovered in 2012, while the SOFR is something that's done on actual prior activity of overnight U.S. transactions, which means that it's a lot harder to manipulate. So I hope you enjoyed. Please remember to rate, review, subscribe, submit comments and potential show topics at globalinvestorspodcast.com. Look forward to 2 more episodes next week. See you then.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.